Welcome to The Explainer. All right, today we're doing something a little different, something special, an exhaustive, unabridged walkthrough of IONQ's latest quarterly report. We're talking about the Form 10Q for the third quarter of 2025. Now, our goal here is pretty ambitious. We want to give you a complete and comprehensive guide to this document. We're going to break down all the key sections, unpack the jargon, and really connect the dots to show you the story behind the numbers. The idea is that this explainer can be a complete substitute for reading that dense document yourself. So if you really want to understand where this company's at, financially speaking, you're in the right place. Let's dive in.
So here's the game plan for this deep dive. We're going to follow the exact structure of the official filing. That way we make sure we cover all the critical pieces methodically. We'll start with a quick overview of what IONQ actually does because, you can't really understand the numbers if you don't understand the mission. Then we are going to meticulously break down the three core financial statements: the balance sheet, the statement of operations, and the all-important statement of cash flows. After that, we'll dig into the massive acquisitions that totally reshapes the company this quarter. And we'll finish up with a balanced look at the risks and, of course, the potential. Let's get to it.
All right, let's kick things off with Section 1, the company overview. Before we get lost in a sea of numbers, and trust me, there are a lot of them, it's absolutely crucial to understand the business behind them. What is IONQ actually trying to build? What is their grand vision here? This is pulled straight from their 10Q filing, and you can see IONQ describes its mission in incredibly ambitious terms. This isn't just about making faster computers, not by a long shot. We're talking about using quantum mechanics to solve problems that are literally impossible for even the world's most powerful supercomputers today. Think about things like designing brand new battery materials at the molecular level or discovering life-saving drugs. Their vision is to create this whole ecosystem to tackle these huge challenges and, as they put it, to transform business, society, and the planet for the better. No small goals there.
So how do you turn a vision that big into actual revenue? Well, this slide breaks down their multi-pronged business model. First, they sell the physical quantum computing hardware itself, which comes with these really important maintenance and support contracts. But they know not everyone can just go out and buy a multi-million-dollar quantum computer. So their second and maybe most important pillar is Quantum Computing as a Service, or QCAS. This is kind of genius because it lets anyone with a credit card access their incredibly powerful machines through the cloud platforms we all already know and use: Amazon's Bracket, Microsoft Azure, and Google Cloud. Beyond just access, they also do professional consulting, helping businesses figure out how to even use this new kind of computing. And thanks to some recent acquisitions, they've now expanded into these super cutting-edge areas like quantum networking and even satellite solutions. They're really trying to own the entire stack of a future quantum-powered world.
Okay, let's get into the real meat and potatoes now. Section 2, and the first of the major financial statements, the balance sheet. You should think of this as the company's financial DNA. This is where we get our first look at the raw numbers that tell the story of IONQ's financial health and its recent, pretty dramatic transformation. Before we dive into IONQ's specific numbers, what exactly is a balance sheet? Well, think of it like a financial photograph. It's not a video showing performance over time. It's a snapshot of everything the company owns and everything it owes on one specific day, in this case, September 30th, 2025. On one side, you have assets, all the stuff the company owns. On the other side, you have liabilities, what it owes, and stockholders' equity, which is basically the value left over for the shareholders. And the golden rule is that it always has to balance. Assets must equal liabilities plus equity. Okay, now for the actual numbers, and this is where things get, frankly, a little wild. What's incredible here is just the sheer scale of the change in only 9 months. Look at total current assets. That's basically cash and stuff they can turn into cash quickly. It more than tripled. But the most eye-popping numbers are further down. Total assets just exploded from about $500 million to over $4.3 billion. And the reason for that becomes crystal clear when you look at one specific line item: goodwill. It has skyrocketed from under $10 million to nearly 1.9 times billion dollars. Let's just put that number up by itself. Nearly $1.9 billion in something called goodwill. Think about that for a second. This single line item is now the largest asset on IONQ's entire balance sheet. It makes up over 40% of their total assets, and it basically appeared out of thin air in just 9 months. So, naturally, this begs a very, very important question. How on earth does a company's goodwill jump by over 18,000%? I mean, that's a staggering figure. It points to a massive strategic shift in the company. To understand it, we first have to define what goodwill actually is in the world of accounting. So here's the deal with goodwill. The most crucial point is this. It's an intangible asset that only gets created on the books when one company buys another one. Specifically, it's the premium you pay over the fair market value of the assets you can actually touch and identify. Things like buildings, patents, and cash. That premium, that extra amount, is paying for all the intangible stuff. The brand reputation of the company you bought, its skilled workforce, its customer lists, and all the expected synergies. So that $1.9 billion figure is a direct result of IONQ going on a major shopping spree and buying several other companies. We'll get into exactly which ones a little later. Now let's flip to the other side of the balance sheet. This is the what the company owes side, and just like the asset side, the numbers are absolutely staggering. Total liabilities have ballooned from $124 million to over $2 billion. And check out the accumulated deficit. That's the grand total of all the net losses the company has ever had since it started. It has deepened from $683 million to almost $2 billion. This tells you the company has been investing and investing heavily for a very long time. But the single biggest number here, the one driving this entire liability side, is warrant liabilities. Almost $1.8 billion. This is the big one. This is the single largest liability on IONQ's books, and it dwarfs everything else. And just like with goodwill, we can't possibly understand the company's financial position without understanding what this is and where it came from. Okay, so what in the world are warrant liabilities? Well, warrants are financial instruments. They're kind of like stock options that give the person holding them the right, but not the obligation, to buy a company's stock at a fixed price for a certain period of time. Let me try to break this down with an analogy. Imagine you have a coupon to buy a concert ticket for $50. Then, suddenly, the band becomes the most popular band in the world, and tickets are selling for $500. Well, your $50 coupon has just become incredibly valuable, right? The company has to record the liability of that value on its books because it represents shares they might have to sell for cheap in the future. So, as IONQ's stock price rises, the value of these outstanding warrants goes up, and so does this liability on their books. And this brings us to maybe the single most important takeaway about this $1.8 billion figure. It is a non-cash liability. Let me say that again. Non-cash. IONQ does not owe anyone $1.8 billion in cash. It's an accounting valuation that reflects the potential for future shares to be issued if these warrants get exercised. Understanding this distinction is absolutely 100% critical for making any sense of the next financial statement we're about to look at, the income statement. And that brings us to Section 3, Operations. We're moving from the snapshot of the balance sheet to the video of the income statement, which is officially called the Statement of Operations. This is what tells the story of how the company actually performed financially over the last 3 months. Okay, so this slide gives us the high-level summary, and wow, it is a wild tale of two extremes. At the very top, you've got the good news. Revenue has grown impressively from $12.4 million to nearly $40 million year over year. That's fantastic. But as your eyes go down the page, the numbers get pretty scary. A loss from operations of $169 million, and then there it is again, that enormous loss on warrant liabilities of $882 million. It all adds up to a staggering, headline-grabbing net loss of over $1 billion for a single quarter. Let's break these pieces down. So let's start with the good stuff, because it is really good. The top-line growth is undeniable, and it's a central part of the whole bullish argument for IONQ. Revenue grew 222% year over year. That's some serious acceleration. This growth reflects increasing traction from their quantum hardware sales, their cloud services, and of course the impact of those acquisitions we hinted at. The company is successfully selling its products and services in a market that's just getting started. But this impressive growth is completely overshadowed by that bottom line number. Over $1 billion. A loss of this magnitude, especially compared to the revenue, is the kind of thing that makes headlines and raises some very serious questions. I mean, how can a company with $40 million in revenue possibly lose over $1 billion in just 3 months? Is the business model fundamentally broken? Well, the answer lies in that non-cash item we just spent time defining. Here's the crucial context. Of that $1.05 billion GAAP net loss, a massive $882 million of it is that loss on warrant liabilities. This is not money that the company spent. It's an accounting adjustment they have to make because IONQ's stock price went up during the quarter. So while it's a real loss under generally accepted accounting principles, that's GAAP, the standard rules for financial reporting in the US, it has absolutely nothing to do with the day-to-day operational health of the business. So what about the real cash-burning expenses?
This slide shows where the company is actually spending its money, and they are spending a lot. Research and development doubled to $66 million as they push to build even more powerful quantum computers. Sales and marketing more than doubled as they expand their commercial footprint. And general and administrative expenses just exploded by 476% to $82.5 million. That includes a lot of stock-based compensation and all the costs that come with integrating those new acquisitions. This is the profile of a company in full-on hyper-growth mode, investing every dollar it can to capture a future market.
That brings us to our fourth section. We've seen the snapshot in the balance sheet and the performance story in the statement of operations. Now we get to the statement of cash flows, which for a lot of people is the most important financial statement of all. This is where we cut through all that non-cash accounting noise and simply follow the cash. So what is a cash flow statement? Well, it does exactly what the name implies. It tracks the real actual cash coming in and going out of the company's bank account. It takes that big net loss we saw on the income statement and reconciles it with the actual change in cash. It's broken down into three really simple activities: cash from day-to-day operations, cash used for big-ticket investing like buying other companies, and cash raised from financing activities like selling stock to investors. This slide really breaks down the whole cash story for the first 9 months of 2025 into a simple 3-act play. Act 1. In their core day-to-day business, their operations, they burned through about $209 million. This is the cash spent on things like R&D and salaries, minus the cash they brought in from customers. Act 2, they went on a massive spending spree, that's investing, and spent $874 million, mostly on buying other companies. So if you add it up, they spent over $1 billion in cash between operations and investing. How on earth did they pay for it? Well, that's Act 3, financing. They were incredibly successful at raising $1.38 billion from investors by selling new stock and warrants. That huge inflow of cash more than covered all their spending, which is why their overall cash balance actually went up. So what's the big picture here? The cash flow statement tells a very, very clear story. IONQ's core business is still burning cash, which is pretty much expected for a company at this early stage. But, and this is a big but, it has been able to convince the capital markets to give it enormous sums of money to not only cover those losses, but also to fund an aggressive strategy of buying other companies to accelerate its growth and its technology roadmap. So let's finally talk about those acquisitions in more detail. And that brings us perfectly to Section 5, Unpacking the Acquisitions. This is where we connect all the dots between that $1.9 billion in goodwill on the balance sheet and the massive cash outflow for investing we just saw. This is the strategic driver behind all the dramatic changes in IONQ's financials. During 2025, IONQ didn't just buy one company. They went on an absolute tear, acquiring 5 of them. These were clearly transformative moves designed to rapidly build out their capabilities. The largest, which we'll detail in a second, was Oxford Ionics. But they also acquired 4 other companies: a specialist in quantum networking, a leader in the cryogenic technology needed to keep these computers cool, a satellite data firm, and a company focused on quantum sensing. It was an all-out effort to build an integrated, full-stack quantum company from top to bottom. And here's the big one. This slide details the acquisition of the UK-based Oxford Ionics, which was by far the largest deal. The total purchase price was nearly $1.6 billion. But look at the breakdown. IONQ only paid $10 million in cash. The vast majority, almost $1.58 billion, was paid for by using IONQ's own common stock. This is a classic move for a high-growth tech company. You use your expensive stock as currency to acquire other companies. So why did they make this massive bet? Well, the 10Q filing gives us the official strategic reason. IONQ bought Oxford Ionics to accelerate the company's technology roadmap for more powerful, high-fidelity quantum computers and support global expansion. Basically, they saw technology and talent at Oxford Ionics that they believed would get them to their goals way faster than they could on their own, and they were willing to pay a significant premium in stock to bring it all in-house. And this story pretty much repeated itself across their other 4 acquisitions too. Okay, we've gone through all the nitty-gritty details. Let's pull back now for our final section: red flags and final analysis. We've walked through all the key numbers from the official filings. Now it's time to put it all together into a balanced overview of the company's strengths, its weaknesses, and the key things an investor should probably be watching. So based on everything we've seen, there are several red flags that definitely stand out. First, that massive GAAP net loss. Now, we've explained it's mostly non-cash, but it creates extreme volatility in the reported earnings, which can really scare off some investors. Second, the high operating cash burn is very real. Third, that accumulated deficit approaching $2 billion is a stark reminder of just how much capital has been invested without yet turning a profit. And finally, a classic risk for any young company: customer concentration. Having your top 3 customers, which are likely major government labs or cloud providers, account for 61% of your revenue means your quarterly numbers are incredibly sensitive. Losing even one of those contracts would have a major impact.
This slide really sums up the 2 opposing viewpoints on the company. It's a classic bull versus bear debate. The bulls will point to their industry-leading technology, that rapid 222% revenue growth, a very strong balance sheet with a huge pile of cash, and a really smart strategy to build an entire quantum ecosystem. The bears, on the other hand, are going to focus on the fact that the company is deeply unprofitable, remains heavily reliant on raising more money from investors to fund its losses, has that customer concentration risk, and ultimately is betting on a quantum market that is still in its very, very early stages.
If we were to try and put a number on all of this, a composite analysis of the data suggests a risk score of 75 out of 100. That is firmly in the high-risk category. The score reflects the deep unprofitability and the volatility from its financials and its stock. However, that risk is offset by its clear technology leadership and, of course, its incredibly strong balance sheet, which gives it a very long runway to pursue its ambitious goals. And so this entire deep dive really leaves us with one central forward-looking question. IONQ has successfully raised and deployed billions of dollars to build what it believes is a world-leading quantum platform. The balance sheet is strong and revenue is growing incredibly fast, but the losses are equally immense. The entire story from here on out hinges on one word: execution. Can they translate their technological lead and all of these massive investments into a sustainable, profitable business? That is the multi-billion-dollar question that the market will be watching in the quarters and years to come.